Investing Secrets with Kevin Attride, empowering you to succeed financially.
Today we're answering your questions, and I have a great friend and an expert, Paul Moore of Wellings Capital. Paul, what type of commercial real estate has the least risk?
Well, you might think I'm going to say stay away from malls and hotels and things like that. And I would do that. I have stayed away from those. But I have a different type of answer. It's been said for years that core commercial real estate has the least risk. These are stabilized, institutional quality assets in great locations. They might have a 4% cap rate, which means that the investor is paying, to get a $40,000 a year income stream, they're paying $1 million for that asset. That's a 4% cap rate. But I would say that's not necessarily true, because if interest rates go way up and if the economy turns, there's very little margin of safety. Warren Buffett says his first rule is don't lose money, and the second is like it. Well, I would say try to buy assets, commercial real estate assets that have a wide margin of safety. How do you create a wide margin of safety? By buying assets with latent intrinsic value. And I'm going to pick one that you might think is the worst, one of the worst out there. In the Amazon economy, it's got to be retail, right? Well, we're about to invest in a retail project that is being operated by a large institutional investor 10 or 15 states away. They're doing a great job, renting out the big boxes like Burlington and Kroger grocery store anchors, but they're doing a terrible job renting the small spaces like to nail salons and pet groomers and barber shops and restaurants, and those rents are way behind. Well, this operator buys that retail strip center. They fix all those small boxes, and they might even carve up one of the big boxes and turn into several small ones that actually work better and get more rent. But listen to this. Then they go out and sell off the out parcels. They might sell off an out parcel to a restaurant or a bank, maybe even the Taco Bell franchise. It's been there for 20 years already. By selling those assets off, those out parcels at a much better price, they're creating arbitrage. They're able to hand back the investors, the equity investors in that deal, within about 2 years, hand them back their principal, and everything else is cash flow. That, my friends, is creating a margin of safety by investing in an asset with intrinsic value.
Paul, thank you for your guidance and your expertise, especially in answering our listeners' questions.
There are more investing secrets that are quite powerful for you to build your wealth. If you'd like a VIP introduction to any one of our experts, click on the link below. Make sure you subscribe so you don't miss a single tip from any of our seasoned experts. Okay, watch the next video so you can capture our next secrets to investing. If you're ready, it's time for you to experience financial freedom.
The information contained in this episode are opinions not to be used as individual guidance. As always, consult your own financial team for your investment decisions.